Prices didn't just rise. They surged so fast that it felt like everyday life got quietly more expensive overnight. Groceries, rent, gas, everything seemed to move in one direction, up. And then something strange happened. The reasons that supposedly caused those price hikes started fading away. Supply chains untangled, shipping costs dropped, fuel prices cooled. But the prices being paid? They didn't follow. That disconnect is where the real story begins. Between 2021 and 2023, the pace of price increases hit levels not seen in over 4 decades. At the same time, wages moved, but not nearly enough to keep up. A paycheck might have grown a few percent, but the cost of living in many cases jumped by double or even triple that rate. The gap between what people earned and what life costs started stretching wider and wider. And then came the detail that made everything feel off. Corporate profits didn't just increase. Profit margins, the percentage companies keep after covering costs, also went up. That's not what usually happens during inflation. Normally, rising costs squeeze businesses. This time, many businesses weren't getting squeezed. They were expanding. That's where frustration turned into suspicion. Executives weren't exactly hiding what was happening either. Earnings calls revealed a pattern. Companies openly talked about pricing power and strong pricing environments. Translated into plain language, that meant prices were raised, customers kept buying, and there was no urgency to bring prices back down. And why would there be? If customers continue to pay higher prices, those prices become the new normal. Even as shipping costs dropped in late 2023 and supply chains stabilized, many of those earlier price increases stayed locked in. The logic wasn't about reacting to falling costs. It was about recognizing that the market could tolerate higher prices. That realization fueled a term that spread quickly: greedflation. The idea behind it is simple. Inflation created the perfect cover. Costs were rising, headlines were full of global disruptions, and consumers expected prices to go up. In that environment, companies could raise prices beyond what was strictly necessary to cover costs, and many people wouldn't question it. It wasn't that the original reasons were fake. Supply chain disruptions were real. Energy prices did spike. Labor shortages did push wages higher. But once those pressures gave companies room to increase prices, the increases didn't stop when conditions improved. Competitors were doing the same thing. Customers didn't have many alternatives. And most people weren't going to change shopping habits over a few dollars here and there, so prices climbed and stayed there. But calling it pure greed doesn't tell the whole story. There's another side that complicates things, and it starts with how costs actually behave behind the scenes. When a business faces rising costs, raising prices is often necessary just to stay afloat. That part is straightforward. But what's less obvious is that those costs don't always drop as quickly as headlines suggest. Take long-term contracts, for example. Many companies locked in supply agreements during the peak of inflation. A manufacturer might have agreed to pay elevated prices for materials like aluminum or wheat for several years. Even if market prices later fall, those contracts remain in place. That means the company is still paying yesterday's high costs today. Lowering prices in that situation isn't simple. It would mean absorbing losses, and for many businesses that's not sustainable. Then there's labor, the stickiest cost of all. During the labor shortages, wages had to increase to attract and retain workers. Once wages go up, they almost never come back down. Cutting pay leads to employees leaving, morale collapsing, or even strikes. So those higher wages become permanent. And permanent higher wages require permanently higher prices to support them. There's also another factor that quietly adds pressure: borrowing costs. When interest rates were raised to fight inflation, the cost of borrowing money increased dramatically. Businesses that rely on loans to expand, manage inventory, or build infrastructure suddenly found themselves paying much more in interest. A company that once borrowed at 3% might now be dealing with rates closer to 7%. On large loans, that difference translates into hundreds of thousands of dollars in additional costs every year. Those costs don't disappear when inflation slows down. They stick around, adding another layer of pressure to keep prices elevated. And then comes the force that often gets overlooked, but shapes almost every decision: shareholder expectations. Public companies aren't just trying to survive. They're expected to grow constantly. Not stay stable, not maintain profits, grow. If profit margins shrink, even slightly, it can trigger a chain reaction. Stock prices drop. Executives face pressure. Investors demand changes. In some cases, leadership gets replaced. That creates a powerful incentive to keep prices as high as the market allows. Even if lowering prices is possible, doing so can be seen as leaving money on the table. So businesses don't just ask, can prices come down? They ask, why would they? And that question sits at the center of why prices feel so stubborn. Because once a higher price is accepted by the market, it becomes the new baseline. Economists have a term for this: price stickiness. It means prices tend to rise quickly but fall slowly, if they fall at all. Once customers adjust to a new price level, reversing it becomes difficult, both economically and strategically. From a business perspective, lowering prices voluntarily can weaken margins and signal vulnerability. From a market perspective, competitors aren't rushing to undercut each other if everyone benefits from higher pricing. And from a consumer perspective, it feels like being stuck. Because even when the crisis fades, the cost remains. This is where the debate gets more intense. On one side, there's the argument that companies took advantage of a global crisis to push prices higher than necessary. The evidence often points to rising profit margins during a time when costs were also increasing. On the other side, there's the argument that the system is functioning exactly as designed. Businesses respond to incentives, markets reward profit maximization, and prices settle at whatever level consumers are willing or forced to pay. Neither explanation fully cancels out the other. Both can be true at the same time, because the reality isn't clean or simple. It's layered. Costs did rise. Some of those costs remain, but prices also rose beyond those costs in many cases. And once those higher prices were accepted, the system made it very difficult for them to come back down. That's not an accident. It's a feature of how modern markets operate, and it leads to a deeper question, not about what happened, but about what kind of system allows it to happen so easily. Because when prices go up, there are tools to slow things down. Interest rates can rise, demand can be cooled, spending can be reduced, but when profits rise, there are far fewer mechanisms to push back. That imbalance is part of what makes the situation feel so frustrating, because it creates a sense that the rules aren't applied evenly. Wages can be restrained, spending can be discouraged, but pricing power, once established, often goes unchecked. And that's why the conversation around inflation has shifted. It's no longer just about supply chains or fuel costs, it's about structure, incentives, and the boundaries of what's considered acceptable in a system driven by growth. Because at the end of the day, companies aren't designed to charge fair prices. They're designed to charge the highest price the market will tolerate. And during this period of inflation, that tolerance was tested and found to be higher than expected. Once those higher prices settled in, something subtle but powerful happened. People adjusted, not because they wanted to, but because they had to. Groceries still needed to be bought. Rent still had to be paid. Gas still had to go in the tank. Life didn't pause just because prices went up. So spending habits bent, stretched, and reshaped around the new reality. And that adaptation is exactly what locked those prices in place. Because from a business perspective, the question isn't whether prices feel high. The only question that matters is whether people are still paying them. As long as demand holds, even if it's strained, there's no natural pressure to reverse price increases. That's why even when inflation rates started cooling, it didn't feel like relief. Inflation slowing down doesn't mean prices are dropping. It just means they're rising more slowly. So instead of prices going back to where they were, they simply stop accelerating as fast. The higher level becomes permanent. That's the part that often gets misunderstood. When headlines say inflation is down, it sounds like things are getting cheaper. In reality, it means things are still getting more expensive, just not as quickly as before. And that difference matters, because it explains why everyday life still feels expensive even when the crisis seems to be over. Now layer in competition, or more accurately, the lack of it in certain industries. In theory, high prices should attract competitors. New companies should enter the market, offer lower prices, and force everyone else to adjust. That's how markets are supposed to regulate themselves. But in practice, it's not always that simple. Many industries are dominated by a handful of large players. Grocery chains, consumer goods, energy companies, these aren't markets where new competitors can easily step in overnight. Barriers like scale, infrastructure, supply chains, and brand loyalty make it difficult for new entrants to disrupt pricing. So instead of aggressive price competition driving costs down, there's often a quiet alignment where companies move in similar directions, not through explicit coordination, but through shared incentives. If one company successfully raises prices and doesn't lose customers, others take notice and follow. And just like that, higher prices spread across the entire market. At that point, it's no longer about one company making a decision. It becomes an industry-wide shift, and once the entire market adjusts upward, reversing that shift becomes incredibly unlikely, because no single company wants to be the first to lower prices and risk shrinking its margins while competitors maintain theirs. So prices stay elevated, not because they have to in every case, but because the system rewards keeping them there. This is where the idea of fairness starts to clash with the reality of incentives. From a consumer's perspective, it feels reasonable to expect prices to come down when costs drop. From a business perspective, lowering prices voluntarily can look like a strategic mistake. And those two perspectives don't easily reconcile. That tension is at the heart of the frustration, because it creates a situation where improvements in the broader economy don't translate into relief at the checkout line. Even when the original reasons for price hikes fade, the effects linger. And over time, that lingering effect reshapes expectations. What once felt expensive becomes normal. What once felt unreasonable becomes accepted. And what once would have triggered pushback becomes routine. That shift doesn't happen overnight. It happens gradually, through repetition. Each purchase at a higher price reinforces the idea that the price is acceptable, at least enough to sustain. And once that threshold is crossed, it's very hard to go back. This is why the concept of a new normal shows up so often in discussions about inflation. Because that's exactly what happens. Prices don't just rise, they reset. And once they reset, everything else adjusts around them. Wages, budgets, expectations, and even definitions of affordability start shifting to match the new baseline. But not all adjustments happen evenly. Wages, for example, tend to lag behind price increases. They move slower, often delayed by contracts, negotiations, and broader economic conditions. So while prices can jump quickly, income takes longer to catch up. That gap creates pressure, and that pressure is what many people feel day to day. It's not just about higher prices, it's about the mismatch between rising costs and slower income growth. And when that mismatch persists, it starts to feel less like a temporary phase and more like a permanent squeeze. That's where the emotional side of the conversation comes in, because beyond the data and the economics, there's a growing sense that the system isn't working in a balanced way. When wages rise too quickly, there are strong policy responses designed to slow things down. Interest rates go up, hiring cools, economic activity is intentionally reduced. But when profits rise quickly, there's no equivalent mechanism to bring them back down. That asymmetry stands out. It creates the impression that certain parts of the system are tightly controlled, while others are left largely unchecked. And whether that perception is fully accurate or not, it shapes how people interpret what's happening around them, because it influences the answer to a bigger question. Is this outcome the result of deliberate decisions, or is it simply the natural result of how the system is built? The answer, again, isn't one or the other. It's both. Businesses operate within a framework that rewards maximizing profit. That's not hidden. It's the core principle. At the same time, the environment during the inflation surge created an unusual opportunity. Costs were rising. Expectations were shifting. And for a period of time, nearly every company had the ability to test how far prices could go. And that test revealed something important. Consumers could tamel higher prices than many had assumed, at least for essential goods and services. That discovery changed the equation, because once a higher price point proves sustainable, it becomes the new reference. And from that point forward, lowering prices isn't just unnecessary. It can feel irrational from a business standpoint. That's why the idea of prices coming back down doesn't align with how the system typically behaves. Prices don't rewind, they recalibrate. And that recalibration tends to move in one direction over time, up. So when looking at the big picture, the question shifts. It's no longer just about whether companies should lower prices. It becomes about whether the broader system creates enough pressure, competition, or regulation to make that happen. Because without those forces, the default outcome is clear. Prices rise when they can, and they stay high when they're allowed to. That doesn't require coordination. It doesn't require a conspiracy. It only requires incentives that point in the same direction. And right now, those incentives are aligned in a way that makes price reductions rare. So the next time prices seem stuck, even when the headlines suggest things are improving, it's not necessarily a contradiction. It's a reflection of how the system processes change. Costs can fluctuate. Crises can pass. But once prices adjust upward and hold, they tend to stay there. Not temporarily, but as the new baseline. And understanding that shift is key to making sense of why everyday life feels more expensive, even after the storm appears to have passed. If this breakdown made the whole sticky inflation concept finally click, consider subscribing for more deep dives that turn complex economic ideas into simple, real-world explanations.